Good afternoon for those who've already joined us. We are going to wait a couple of seconds more for everyone to come. Okay. Okay, good afternoon, everyone, and welcome to this webinar. I'm sure a few more people will come, but by the time I'm done with the introductory remarks, everyone will be in the Zoom, in the call. So my name is Stanislas Jordan, and I am an associate researcher at Sustainable Finance Lab, and I will be moderating the discussion today. Maybe a few words on Sustainable Finance Lab for those who may not be familiar with our work. Sustainable Finance Lab is a think tank based in Utrecht in the Netherlands, and it was founded 10 years ago in the aftermath of the great financial crisis by a group of professors from all across Dutch universities and working in different policy fields. Our aim is to bridge science with practice, and we work at both national and European level to promote policies and reforms that favor a stable and robust financial sector that contributes to an economy that serves humanity without depleting the environment. Today's webinar aims, to tackle a complex European challenge, which is made of the climate emergency. We need to respond to the climate emergency by reducing greenhouse gas emissions as soon as possible in order to reach our commitment towards the global community. Second, we need to increase strategic autonomy, in particular vis-à-vis trade partners, which have become unreliable partners, such as Russia and the US under Trump. And third, we need to restore the competitiveness of our businesses and industries, which, among other factors, have suffered from and continue to suffer from high energy prices after the war in Ukraine. And last but not least, we need to carry out this transition while at the same time keeping citizens on board with our social contract. In an era where populist and extreme right forces have been successful, unfortunately, at exploiting the anger and frustrations of some of our fellow citizens. A common denominator for how to address these challenges is to accelerate the energy and decarbonization of the energy system. On the one hand, we need to increase domestic production of clean electricity and energies, and at the same time, we need to optimize and reduce our energy consumption through energy efficiency or storage. In addition to helping our climate and security agenda, a swift and successful energy transition will eventually bring about more stable and lower energy prices. And this will make European businesses more competitive while at the same time reducing energy bills. But this is not possible in the long run, on the short run, because we are still in the middle of this process. So a key challenge, of course, is that doing so requires front-loading enormous amounts of capital investments, and in renewable, in grids and storages, energy efficiency of buildings, and therefore the role of capital cost and interest rate is key in this endeavor. At Sustainable Finance Lab, it is our view that all actors, all public institutions, and all policy instruments should be leveraged and used in synergy with each other. And this includes, therefore, central banks. For almost 10 years now, we have been actively contributing to the discussion on whether and how the European Central Bank should support the transition. And we have put various proposals, including one of them being a green interest rate idea by a proposal that the ECB could do. But today we want to take a step back from jumping to solutions, and we want to explore a more basic, actually fundamental question. Has the ECB's interest rate policy helped or hindered the green transition in recent years? As we will hear today, this is not a straightforward exercise to look into this question. Different methodologies may show different results. And in order to help us unpack this issue, I am pleased and to welcome and introduce you to our two speakers of the day, who will both present cutting-edge research in this field. Our first speaker is Andrea Polo. He's an associate professor of finance at Maastricht University in Rome, and he also works as a consultant for the ECB. He researches on banking and corporate finance, and together with ECB economist, he has recently published a paper called Climate Risk Bank Lending and Monetary Policy, which he will present to us. And our second speaker is Mark Sanders. He's a professor of international economics at Maastricht University and a founding member of Sustainable Finance Lab. Together with colleague, he has written a paper on the effects of monetary policy rates on energy technologies, which he will also present later. But before we start, let me remind you that today's discussion will be recorded and the video will be made available to the public, as also the slides. We will share them later. Of course, you're all invited to ask questions or share remarks to our speakers using the chat. And yeah, without further ado, let me now give the floor to Andrea for his presentation. And thank you for being with us. And I'll give you now the floor. Thank you.
Excellent. So many thanks for the invitation. As she was saying, this is a joint work with Claude Trevilla and Miguel Bosigna, who are at the ECB in the DG Monetary Policy, and Marco Pagano, who is in Naples. So let me jump on the questions that we try to tackle. Okay. So well, the first question we try to tackle is whether banks, when they price loans, they take into account climate risk. Okay. And whether they do this over and above credit risk, okay, when granting their loans. Particularly, we're going to assess whether banks take into account current carbon emissions or also forward-looking current emissions. And by forward-looking current emissions, we're going to use as a proxy whether the firms disclose a commitment to reduce emissions in the future. Then we're going to also look where the banks themselves, who declare themselves as committed to decarbonization, whether they charge a higher premium on climate risk. And then the second question, which is central to this afternoon, is whether monetary policy change its pricing. Okay, when you change rates, do you change the pricing of climate risk? Okay, so to give you a sense, when rates go up, which firms are more penalized in terms of higher interest rates? Okay, so what do we know? Okay, what do we know? So first of all, we know that security markets seems to price climate risk. Okay, so there's ample evidence of this. For credit markets, we know much less. Okay, because the evidence that we have, which can go both ways, is limited to syndicated loans. I remind you that syndicated loans are like 10% of credit to the economy in Europe. So I would say that we don't really know. And then also there's not much consensus whether banks which commit themselves to environmental policies do walk their talk, okay, do lend preferentially to low emissions firms. Okay. Finally, we're not aware of any paper which try to look at the impact of monetary policy on the pricing of climate risk in bank loans. So which data do we use to tackle this question, which is pretty complex to do it and requires very detailed data. So in Europe, in the euro area, since 2018, we have the so-called ANACredit database at the ECB, which cover all euro area countries, and from 2018, we know at the loan level everything. Okay, we have all the bank firm relationship, we know many loans, what is the quantity, the maturity, the collateral, the price, everything. Then we merge this data with data on emissions, okay, both, as I was saying, current emissions and commitments to reduce emission in the future. So backward-looking and forward-looking. Consider that this forward-looking, that is what we're going to use, is whether the firms themselves disclose a commitment to reduce emissions. There is already evidence which shows that indeed, if firms declare, they see a reduction we observe a reduction in emissions in the years afterwards. Then we also look, as I said, on the commitment on the side of the bank, where instead we know less. We want to see whether the bank which says we commit, whether indeed walk their talk. Finally, the last piece of data is monetary policy shocks. A big challenge if you want to look at monetary policy and whatever outcome is that monetary policy is one of the most endogenous variable that you can think of, because of course central bankers react to the state of the economy, and so what we do is that we use the high frequency monetary policy shock. What it is that whenever there is an announcement of monetary policy, we look at the reaction in the 15 minutes after the shock, and we make it as a monthly variable, okay, to understand whether it's a tightening or an expansionary move. Okay, so what is the result? What is that we find? So if we just look in aggregate data, okay, so this is firms, and we look at the interest rates that they charge, the banks charge them, and on the first graph is the green line is what the company with low emissions, okay, and here instead the red one are companies with high emissions. So indeed the red should be brown, okay, just to give you a sense. Okay, so what we find is that the interest rate spread, so we look at the spread, okay, we don't look at interest rates, we look at what banks charge on top of the current interest rates. You see that banks which pollute more, pay more, okay? So you see the spike here, so the spike, of course, this is 2022, but this is not due to the fact that interest rates went up, because remember, I look at the spread. But the thing is that also the credit spread, when interest rates change, also credit spread change. What banks charge on top of the interest rates tend to go up. Okay, so we see these also in this time. And this is instead if I use this other variable, the commitment. So the green are the firms which declare a commitment to reduce emission in the future. The red are the ones which don't declare any commitment. Okay, this is just aggregate. As you can see here from the label, we're talking about around 20 basis points of difference between the two. Okay, so then this is aggregate. This could be explained by many different things. So let me do a proper regression analysis. What we want to see, so as a dependent variable, I have the interest rate, the spread. I want to see whether controlling for traditional risk, controlling for the probability of default of the firm, okay, whether these two variables, backward-looking emission, forward-looking emission, are priced. And what you see is that not only it's priced traditional credit risk, but also these other two variables, and with the opposite direction. What is the size? So we have around 4 basis point premium, which is around 5% to the standard deviation of the spread for firms which are polluters, and the 10 basis point discount if instead these firms commit to reduce emission. Okay, you see positive and negative. To get a sense whether is it large, is it small, well, the probability of default, okay, the variable which you think, okay, that of course should be priced. So the premium is 3 basis points, okay, on firms with high PD, okay. Consider that this is a sample of listed companies, okay, where the variance of PD is not very high. Okay, then we ask, okay, now it's priced both forward-looking, backward-looking, but the committed banks, the one which they declare that they are committed to decarbonization, what do they do? And what we find is again, look at this double interaction, positive and negative, which says that if the bank is committed, they charge more, okay? Sorry, they charge less if the firm is committed, and they charge a bit more if the company is high emission. So on top of the average result, if the bank is committed, you find these additional effect. Banks seem to walk the talk. So here the variable commitment is whether these banks are signatories or these SBTI, Science-Based Target Initiative, and we do find that they seem to walk the talk. Okay, what about monetary policy? Is monetary policy changing this pricing? Okay, so here we put again, the spread is the left-hand side, and then we put monetary policy. Okay, monetary policy, as you can expect, increase in monetary policy, increase the rate, the spread. Okay, this is what we expect. And we expect, this is the risk-taking channel of monetary policy, then when there is tightening of monetary policy, the one which suffer the most are indeed the one with high credit risk. Okay, so the risk-taking channel monetary policy says that when there is expansion rates, banks lend more and they lend more to riskier guys. Okay, this is what this coefficient says. Now, what we find is that on top of that, we find the same seems to be true also for these two climate risk proxies. Okay, so when there is indeed an increase in monetary policy rates, an announcement of increase in rates, you find that high emitters, so the polluters, so everybody knows you see an increase in interest rate for everybody, but you get a bit more for polluters and a bit less for firms instead to commit to lower emissions. Then the concern that we had at the point is that, look, this is month on month. So you see a shock, and then you see what you do in the month. But then, monetary policy happens, as can have effect with lags, right? And so we look at as people tend to do in macro, to look at like an impulse response function, or what we call in econometrics local projections. That is, okay, let's look at the larger horizon. And what you see is that when there is an increase in interest rates, okay, immediately spread goes up, but then in the following 12 months, okay, they keep increasing while they decrease at the very end. And these effects tend to be larger, so they increase a bit more to polluters. So this is around 2 basis points for high emitters, and they tend to be negative for firms which commit to decarbonization. Let me say it differently. Okay. So when interest rates go up, there's a tighter monetary policy, interest rates go up for everybody. But they go up a bit more for polluters and a bit less for firms which commit to decarbonization. Okay. Now, this is, let me not enter too much in the details, but this is the symmetric effect if we look at quantities. Now, so far we just talked about pricing, but the same if we look at quantity. When there is a tightening of monetary policy, there's not much on impact, but in the following months you have a reduction in quantity to everybody. But this reduction in quantity, not much on impact, but then within 1 year is an additional drop of 2.7% if you are a polluters, while instead this reduction in quantity is less so. There's a 1.5% mitigation effect for firms which instead are committed to decarbonize. Okay, the last. Okay, so now this is we use this high frequency shock, but same happen if let's say we take the shock of 2022, July 2022, when there is this announcement, and we look at firms with the high emissions of firms which commit, and we find the same results. Okay, let me just give the last piece of evidence. Now, for the first time in July 2023, the ECB asked banks if in the previous years they changed their lending policy differently with respect to brown firms or to firms in transition or to green firms. Now, how they are defined, the banks decide how to define that, okay? As you can see, they tend to tighten the standards for brown firms while make it softer for green firms and from firms in transition. And here instead I can unpack whether this is done in particular by committed banks or by non-committed banks, and this is done particularly by committed banks. Okay, so let me recap. So what we find is that Euro area banks price climate risk. So they consider it a risk, okay? Because on top of the probability of default, on top of the traditional PD, the banks assign a PD to the borrower. On top of this, when we control for this, there is this additional effect from whether banks have high or low emissions. Okay. And we showed that also banks' commitment matters. So committed banks provide indeed cheaper loans to firms that commit to decarbonization, which are green. And we find this evidence of this risk-taking channel monetary policy. So there is already a lot of literature on the risk-taking channel monetary policy. But if this is considered risk, as we show, okay, we expect this to be at play as well. So when there is a contractionary rates go up for everybody, but they go up a bit less for firms which are green or they commit to decarbonization. Okay. That's the gist of the paper. Thank you.
Thanks a lot, Andrea, for managing to unpack this complicated research into quite intelligible explanations. And yeah, your results are quite encouraging then. So Mark, how about your findings? What did you find in your research?
Yes, thank you, Andrea, for laying this out and saving me the time to have to motivate why this is an important question. But I also, if I briefly summarize what you said, you might conclude from this that the market is taking care of business, it's pricing in the risk, and so we can all go to sleep easy because the climate problem will be addressed under the current situation. And I think our paper kind of shows that that is not the whole story. And I think it's important to point out at the beginning, oh, by the way, this is joint work with Sasha and Friedemann from Utrecht and Maastricht University. And we have done this paper as part of our work in the European Horizon Project Diamond, where the purpose is to try and improve integrated assessment modeling for climate policy. And we focus on the financial markets in this particular paper. And I think it's fair to say, Andrea, that your paper shows clearly that banks do price transition risk in their portfolios, in their loans. But of course, in the end, what matters for the energy transition, I would argue, is whether this affects the relative competitiveness of green technologies in investment, in making actual investments, in building extra capacity. And what we show in this paper, and I will briefly go over it, is basically what we set out to do is look at monetary policy and monetary policy changes. And the purpose of these monetary policy changes is, of course, to affect aggregate investment decision making in the economy. If you tighten monetary policy, you want to slow down investment. And if you broaden it, then you want to stimulate investment so that in the aggregate demand responds in the direction that you need it in order to manage your inflation. Now, so far so uninteresting is first year bachelor stuff, I would say. But the tricky thing is, of course, if these investments are not affected neutrally in the entire economy, but basically there's biases in these channels. And so what could be an argument for why these biases exist is because some sectors may simply be more capital intensive, more capital dependent than others, depending on some rather than other sources of funding. And these biases can then be translated into changes in the relative competitiveness of technologies in any sector. And in this paper, we focus primarily on the electricity sector. So in this paper, we explore the effects of monetary policy rates on utility scale energy installations, so new built energy production facilities at the utility scale. So in that sense, serious, not early stage finance, which is a different story altogether. And then what we find, if we look at this carefully, is we find interaction effects with the technology characteristics, as I said before. So we have a negative coefficient for the external finance dependency, EFD, and the market rates, the monetary policy rates that the central bank sets. And we find a negative coefficient on the interaction with the investment intensity. So the amount of investment that is needed relative to the flow of retained earnings in a sector. And that has a lot to do with how mature a technology is, in this case, the electricity market. And what that implies, what these findings imply, is that the less mature renewable energy technologies, specifically in our sample, wind on sea, and solar panels, they are disadvantaged in monetary contractions and advantaged, I can add, in monetary expansions. So over the period that we have investigated this, from 2001 to 2024 by now, because we added some data relative to the first version, which ended in 2021. So we now have included also the monetary contraction that followed the energy crisis of 2022 from the top of my head. And what you then find is that indeed in expansions, you give a little bit of wind in the back for the renewable energy technologies in the early years relative to the fossil technologies. But in a contraction, this also this bias is also present. And it depends, as I said, on these dependencies of different technologies on external finance. So here you see a picture where we calculated the external finance dependence for the key energy technologies in electricity generation. And you see that this is also not constant over time. So early in the sample, the external finance dependence for these renewables was much higher than later. So this bias is there in our sample. I will show you the results, but it is also decreasing as these technologies mature. Their disadvantage in a contraction and advantage in an expansion will be reduced. So what we did is we did a fixed effects panel regression where we had a set of dependent variables, the log of new capacity built, so increases in capacity, I see, the growth rate in that, and the LCOE, the levelized cost of electricity, and the investments in the technologies that we considered separately. And then we have technology type, country, and time fixed effects there. There are the coefficients that we are primarily interested in. The monetary policy interacted with the technology types and industrial characteristics. And finally, some controls and additional variables that we wanted to put in there, because of course, a lot of factors can affect the transmission of monetary policy shocks to investment levels. The data that I added here in one slide is just for you to see. We have by now covered up to 2024, 29 countries. It's annual data, so it's one country, 1 year observations. And we now include the energy price and supply shocks that followed the invasion of Ukraine. And then the results are not too different whether we in or exclude those years. And this is the picture that shows in one go, I hope, the results, where you can see the MBR is the coefficient on total monetary policy rates. So that's the baseline, and you can see that investment is reduced when policy rates go up. So this coefficient is significantly negative. But then if you interact on top of that, you see that the fossil fuels, the nuclear, the hydro, shall we say, the mature technologies in Europe for generating electricity, they have an insignificantly different total marginal effect, which means that they are not affected negatively or positively, or I should say not significantly negatively or positively by these changes in the policy rates. Whereas if you look at the biofuels, the onshore wind and the solar panels, there is significant negative effects, and especially for solar PV, you see that the new installed capacity is very sensitive to the changes in policy rates. This paper or this table shows the interaction effects with the technology characteristics. So we have the external finance dependence and the investment intensity of the sectors, and you can see that they explain a significant part of the variation in these effects. So the technologies that have a high external finance dependence and a high investment intensity are much more sensitive. And so it's not the emissions that are related to the activities. It's not whether it's green or brown, but it really is about how capital intensive is the production of the green versus the brown, and how mature is the technology versus of the green versus the brown. And when it's these technology characteristics, it also opens up, let's say, new ways of thinking about maybe adjusting the policy. Now, that brings me to my concluding remarks. I want to highlight this again. It's the industrial characteristics and technology maturity that drive this negative effect. Less mature renewables are negatively affected by monetary contractions and positively by loosening, because they are more dependent on external finance and they are more sensitive to the cost of capital. The mature fossil fuels are less sensitive or actually unaffected in our results, and that means that in relative terms, that in a loosening you would see the share of renewables increase, whereas in a contraction you would see it decrease. And of course, when the purpose of our policies is to make the transition to fully renewable energy production, it's not a problem if we have a bias in a monetary expansion, because it works in the same direction as we want to go with the energy system. But in a contraction, this becomes a contradiction. And again, Andrea also showed it, how big are these results. If we look at a 25 basis point increase in policy rates, which is, I would say, nothing spectacular, you would actually get an 8% drop in newly installed wind installations, 26.5% drop in solar. That is really large. It does not immediately have such a big effect in terms of percentages on the share of these technologies, because they are still already at the start, or still at the point where they're gradually increasing their share in the mix. But still a 0.6 percentage points rise in the fossil fuel share. If you have a 25 basis points increase in policy rates, seems significant and something to address in additional, shall we say, flanking policies. Because if you look at the mandate of the ECB, I've copied this from the legal text. The primary objective, we all know, of course, maintain price stability, and that is interpreted as 2% year-on-year price increases. But the second sentence is really crucial: without prejudice to that objective. So if we need to make a contraction, we need to make a contraction, but we then need to make that contraction in such a way that it still supports the general economic policies in the Union. Of course, that is a very important policy. There is the Fit for 55 and the targets for 2050 to decarbonize our energy system. And so therefore, in a contraction, I would argue the European Central Bank should consider flanking policies to prevent the negative impact on the energy transition that our results imply. Thank you very much.
Thank you, Mark. So in a short while, we will take questions from the audience and have interactions. Maybe before we do that, because I think it's quite important for the whole discussion that we all understand how the different papers differ, and of course they may seemingly appear as contradictory or not saying the same conclusion, but actually maybe we should actually look at that a bit more thoroughly. So maybe I would like perhaps to give back the floor to Andrea for just 1 or 2 minutes, just so you can actually react a little bit and explain very well why you don't find the same result as Mark.
Excellent, many thanks. So first of all, we're just presenting a very good paper, which I envision this will be an important contribution to this debate. However, the papers do different things. So while the paper that we have seen looks at firm behavior, so at the investments at the firm level, what we do in our work is that we examine with very granular bank firm loan level relation the bank behavior, okay, where banks consider it a risk. This is a question, and if this is considered a risk, and what we find is that consistently with the literature on the risk-taking channel of monetary policy, they take different. So there is this climate risk-taking channel of monetary policy, but we cannot say anything at the firm level. Okay, let me come back on this in a moment. Consider also there is another very significant difference. That is, these data are my data, our data are a monthly level, and for a short amount of time, 2018, 2022, just because this is the only time for which we have this data on unaccredited did not exist before. While this paper look at yearly data, and the sample is very different, so it's much larger, broader, and now it's not only 2021, but we have seen that they also extended it, because you can do it with the yearly data. Okay, so let me give you my reading of these two papers together. So my reaction is that this could be complementary. Okay, my results on the bank risk taking do not contradict firm level findings. While banks, remember, banks increase rates to everybody. Well, what we have seen is that when the rates go up, what we have seen is that they increase them a bit more to brown and to firms who don't want to commit. Okay, but it could still be the case that firms which are committed to decarbonization, for them interest rates are so important relatively to other firms that even it's true that they increase a bit less than the other ones, but still this could matter more at an investment level. First point. Second point, well, banks are not the only source of finance. There are other financiers. These are like listed companies. It could be bond markets, it could be private equity. So this might exhibit opposite behavior. So we know in the literature on banking that when banks cut, other institutions lend more. So potentially it could even offset the results on bank loans. Third, mechanisms other than the bank lending channel could operate in the opposite direction, okay? Potentially offsetting and find this aggregate effect on green investments that the authors find. Okay, so these were the 3 points that I wanted to bring to the table. Many thanks.
Yes, thank you, Andrea. I think it was important to show that it's easy. This debate is not about confronting who is right or wrong in this debate. It's just showing different evidence and trying to understand collectively what type of research is showing what, and what type of research maybe we should do in the future to continue to tackle this research issue. Okay, so I think I see already a few questions in the chat. Maybe let's stick with Andrea in a while. So I have maybe one just quick follow-up questions for you, because you presented encouraging findings on the fact that banks do price in climate risk already, but I mean, how significant is this green spread that you present to us? I mean, it was basically in terms of basis points, right? So I mean, how do you compare that maybe with the premium on bond markets or other type? How do you evaluate the order of magnitude that this is giving us?
So yeah, exactly. So very good point. So The thing is that now, so there are many papers on security markets just to conclude that this is price, but how large? So there is now a very nice paper, which is a survey, and they say that this is in the order of magnitude of 10, 15, 20 basis points. Okay. Consider that we're talking about a risk which could materialize in the long run. Okay, so this is the evidence that is found in security markets, and our evidence maybe slightly smaller than this, but is in the more or less in these 10, 20 basis points level. This is what other people find. Is it enough? This is enough for the decarbonization? This is a very difficult question. It's difficult to answer. We're able to put a number, but to say this is enough, then one should do some sophisticated back of the envelope with many assumptions. But let me just give you another point. So, for instance, when I was doing this study, I was concerned, well, what about probability of default? Because in a sense, if the banks think that this stuff is, affect the probability of default, because there could be a carbon tax and these firms can struggle, this should be incorporated in the PD to be already. But the thing is that PD is the probability of default within 1 year, while climate risk now is a much longer horizon. And in our study, we find that this PD and these other risks have a similar magnitude.
Thank you. Thanks a lot. And then maybe one follow-up question then for you, Mark. I mean, first of all, there's a question actually in the chat by Tessa Dipperink, who asks, can you explain the difference between the impact on solar PV and other technology? I think wind is the main other technology you find significant. Do you have any explanation for why this is solar PV is affecting largely?
Well, I think what you should keep in mind that the sample period is important, 2001 to 2024 in the latest regressions. And what we have seen in that period in solar was quite dramatic. Our costs have come down dramatically. Installations have been rather massive, maybe more so than on and offshore wind. Onshore running into permitting problems, into not in my backyard dynamics. Offshore wind still struggling to find connections to the shore. So especially in PV, you saw a massive expansion, and that is picked up. So under the period that we're looking at, so from 2008 onwards, policy rates have been very low and have been reduced, and in that same period there has been a significant expansion of solar panels. So that I think that may have inflated that coefficient a bit relative, especially to wind and wind onshore, wind offshore. So I think that's part of the explanation, but we have not. I'm still struggling to find how you could identify that separately from the monetary policy channel, because these things happened at the same time. I would not attribute that complete expansion of the solar panel industry to the monetary policy stance only.
Okay, thank you.
So I hope that partially answers that question. And I think, I fully agree with Andrea. These results are not contradicting each other in that sense, because indeed the sensitivity of individual firms and their investment decisions to interest rates is not part of what Andrea was trying to study and has studied, I should say. So it's really interesting to see that banks are pricing in transition risk, and do that obviously based on their expectations of the future. So what's also in there is, let's say, discounting the risk of those risks materializing when policymakers are not completely, shall we say, committed to their climate policies. That would also, I guess, make it harder for Andrea to find the results that he finds, because they would be smaller. And so it's all the more interesting that he still has the significant effects.
Andrea, do you want to say a few more words on this? You seem to agree. Yeah.
No, this is exactly right. So consider when the ECB moved on this direction and say, look, you need to do more to banks not to decarbonization with the climate stress test. They, for instance, they did not ask, look, incorporate climate risk in the PD. Remember, the PD is what is super important, because on basis of PD, we base the capital requirements. Okay. So that is a very bold move, and the ECB didn't do it. Of course, there are reasons why not to do it also, because it's very difficult to incorporate it in the PD, because we do not, remember, PD is based on models, based on the past. Now, what do we know about climate risk? Okay, we increase PD by epsilon 0. Okay, so there is not much of scientific base on how to do it, to incorporate into internal models. But so yeah, so this is the only point I wanted to add.
Thank you. So there's another question by Aurora for you, Mark. So she asks, how do you assess the effects of monetary policy on installed capacity controlling for the inflation effect, especially price effects from supply chain disruptions?
Yes. How do I assess those effects? Well, I think we control for a whole list of things. So let me double check that I don't tell a lie here, but I think inflation is in there. Let me see what we have. Well, at least GDP is in there. Short-term interest rates. Yeah, that we've used the harmonized. Yes, now I remember. It's been a while since we were heavily involved with this. We've used the changes in the price index also as a control on the as an instrument to estimate the effects of monetary policy on the levelized cost of electricity. So to control exactly for this, supply chain disruptions and price hikes that may have existed and definitely did exist in 2022. And that does not change our results qualitatively. Of course, the numbers are slightly different when you control for that or not, but the general picture remains the same. And so that there really seems to be also independent of these disruptions in the energy markets, an effect of the technology and the maturity of the technology on their through their sensitivity for cost of capital, that then opens a road, an avenue for differential impacts of the same monetary policy change on different industries in the direction that I've shown.
Yes, and so maybe then let me ask you a follow-up. I mean, so in your conclusion, you were talking about the need for flanking policies. I mean, do you want to be more explicit about what you would do to compensate or mitigate the effect that you see? What do you have in mind?
Yeah, so well, if you're doing a contraction, which sometimes is necessary for your primary mandate, then you should try to do that in such a way that it does not interfere with the process of energy transition. And the easiest way to do that is to make sure that the interest rates for those investments do not rise would be the first thing, or at least do not rise as fast. And of course, Andrea's work already shows that to some extent banks will already price that in, but I guess our work then shows that that's not enough to overcome or to prevent the relative negative impact on the actual investment decisions. And so I guess if you have a portfolio of tools, monetary tools in the ECB, buying of corporate bonds as they did under quantitative easing, or differential rates for green and brown investments, or the TLTROs have been mentioned. You can think in that direction.
Okay.
And that would be justified not only because you're a bleeding heart green, but also because the central bank would want to be neutral in implementing its monetary policies. They want to achieve price stability, but not cause changes in undesirable changes in the composition of the economy.
Yes, thank you. I don't see more questions now, but please don't hesitate to ask questions. Or also, you could also share. I mean, I know that in the audience we do have people involved directly from in this industry, actually. So I think it could be also interesting to get your first-hand experience. But yeah, if there are, well, oh, actually, there's a question which I haven't read yet. But let me analyze it a bit. So it's asking about.
That's the tension between
I
government.
guess yeah, exactly. So I guess the question is for you, Mark. Then how does this proposal for differentiating interest rates or capital costs go about with the independence?
Well, first of all, the central bank is independent, yes, but they have a very clear mandate. I put it on the screen. So by that mandate, I think also, what's his name, the Dutch member of the board of the ECB, Frank Elberson, has said on record that second part of the mandate is not optional; it's mandatory. It's mandated. So yes, they're independent, but they're independent in fulfilling that mandate, and therefore I would argue that there is a good reason for having these flanking policies. Nonetheless, or nevertheless, governments, of course, can also act because, of course, these things also likely differ by country and local context. Some countries have more natural resources available for doing wind versus solar. It may have that may be a reason for a national government to also interfere and intervene. And they have instruments for that. So probably all European member states have support programs for renewable electricity. It's a little bit more complicated, but maybe I defer also to Andrea here. If we broaden this to brown and green firms, period, so including industrial firms, services firms, because the UNACredit data that Andrea has looked at, the richness of that is really in the many different sectors that are being addressed, and these pricing effects could definitely be strengthened by national governments. I'm sure.
Yes. Do you want to react, Andrea?
Right. So yeah. So there's not much evidence on subsidies. What is the effect on subsidies on firms and on the behavior of bank with respect to green subsidies, which is clearly one of the tools that the governments can use. The other thing I wanted to stress is that I think we should work more on the taxonomy, because green versus brown is highly unsatisfactory. Because the thing is that we want banks to lend to brown firms who wants to transition. Okay. But the risk is that since this is the label, if the label is on the firm and the label is not on the loan, okay, so we may have the results that, as for instance, Kamersiski and Bolton showed that banks which commit, they lend less to high emitting firms. But this is bad, because these high emitting firms then they switch to projects which are less costly, and so they keep being brown. So I think the taxonomy should really, and I think the European Commission is going this direction, that we really want to know what they're lending for, okay, rather than who they're lending to.
Yeah, I think you refer to an important discussion indeed in Brussels, which the green taxonomy has been made to avoid greenwashing in a sense. But there's a parallel debate about transition finance, and I think there's an ongoing discussion on how to better capture this type also of financial flows that we also need.
I understand very well that there is a problem of greenwashing, is that if you do that, then how do you enforce it? Okay, so there are these concerns, but wait, we already are seeing the perverse consequences of lending less to high-emitting firms, because this means less transition. This is not my work. I'm citing here Patrick Bolton and Marcin Kaperczynski at the Imperial College.
Right. Okay, we're getting close to the end of the hour, so maybe a final question from me for both of you actually would be, what would be the one next steps, taken by yourself or maybe others, or could be institutions or whoever. What would be the one next step you would like to see being done in this field in order to advance this question of better understanding the contribution of monetary policy or the cost of capital in general on the transition? Is there something you think is missing, or that you wish someone would do? Andrea, do you want to go on?
So on my side, so this thing of the taxonomy, what is the loan for? Okay, I think that will really help researchers. So consider that this could be done as an addition. So I think a loan in Anacredit has like already 35 items. Okay, if you can add another one, I think it would be really could be really useful in that direction.
So you mean in Anacredit when you said 35 data points?
You do a loan for what?
Yeah.
What for?
Yeah. So indeed, if we could connect this with
in particular for term loan, not for K lines. Of course, K lines are general, but if it's a term loan, typically this is attached to a specific project. So I think it will be a big advancement with potential costs. So it needs to be studied, of course, to say why you're doing this lending to all.
And thank you. How about you, Mark? What is on your to-do list or your wish list?
Well, academically, I'm fascinated by this capital demand, finance demand per over the product life cycle or the technology life cycle. So as these technologies mature, how does the financing mix change? How does the cost of capital change? There are some interesting papers that have referred to this financial learning, and be really interesting to see if you can also see the more experimental technologies today go down this slide, let's say, and become competitive as their size in the total increases, because that would have really interesting implications, especially if you promote early on the diffusion of these technologies, learning about how they work and how they can be financed, and getting them down to this lower financing cost universe could be a very powerful strategy with positive, spillovers to the future. And I would also be very interested to see this expanded beyond the borders of the EU. It's of course very interesting to know about how this works for the EU and what the ECB should do. But if you find similar patterns, it's a global market, it's a global process, it's also a global problem. And I can imagine that especially in developing countries, the global south, but maybe also China, these dynamics work differently, and that would also be very important to investigate, also for policy.
Yeah, I mean, indeed, there's research by colleagues, right, in Netherlands, who have really shown that the cost of capital issue is even more acute in Africa, let's say, or other countries. So indeed, this is indeed a big issue. Okay, I see the time is almost out. So I mean, what have we learned today? I mean, in my side, I've learned that on both papers, both methodologies show that even though paradoxically the ECB changes just one interest rate, but actually the effect of that is not just uniform. And depending on the cost of capital, on the capital intensivity of the sector of the firm, but also technology characteristics and maturities, the effect is different. So I think it's important to have in mind that it's not as simple as one interest rate, monitors and controls the whole economy in a smooth way. And I guess the second learning is still maybe an encouraging one, is that Andrea's research shows that banks are taking climate into consideration, and this is probably also due to all the work that some of us are doing in Brussels to advance the sustainable finance agenda. So of course now it's a matter of scale to see, is it enough or not, and what else can we do? And I guess the third learning is that as often we realize how much little we know, even though all the work we know, all the work we do, it's always too little to completely understand the bigger picture. And so I hope that wherever you work, if you work in whether you work in the industry, in banks or central banking, or in governments or in a research institution, we hope that you all agree that we need to do more work together to advance this research field. And in that sense, if you plan to do further research activity on this, don't hesitate to reach out to our team, to the authors as well, to Mark and Andrea. I'm sure they would be interested. And more collaboration can certainly help. So a huge thank you to both Andrea and Mark for your time and for your presentations. Thank you for the Sustainable Finance Lab team for helping me set out this webinar. Thank you, Alex, in particular. And thank you all for joining and for participating. And on this note, have a great afternoon and the rest of the week. Goodbye.
Bye. Thank you.
Bye-bye.